Russ Kostrich joins us now to talk more about what these big market gyrations mean for your money. He's the global chief investment strategist at BlackRock. Russ, welcome back. Good to have you with us. You know,
thanks for having me back.
I don't mean to put lipstick on a pig of a day, but it occurs to me that on a day like this, with a violent move, that individual investors have an advantage. The advantage is that they're not graded every day. They're not even graded every quarter. They don't have to do anything.
I think that's right. And honestly, in the near term, we might see additional weakness. The market is adjusting to an environment in which the Fed will be less accommodative. But I think, thankfully, the longer-term fundamentals are in place. And if you're not a professional manager, you're not marked quarter to quarter, and you're comfortable with the stocks you own, well, the best thing to do might be to simply sit tight and look for some bargains, which this market may present.
Mm-hmm. But Russell, why are these big moves back? You know, one day up by triple digits, another day down by triple digits. Why are they back? And are there more to come?
I think the answer is yes. There are more to come, which is unfortunate. I think the market can go higher, but it's going to come with some more bumps along the way. Really, what's changed is we're getting closer to the point when the Federal Reserve will start to remove monetary accommodation. And that's a very big deal because for the last couple of years, we've had an unusually quiet market, very low volatility. And a large part of that is because monetary conditions, credit conditions have been very easy. As that starts to normalize, volatility will normalize. And again, it doesn't mean we're going back to 2008, but it does suggest a rockier, bumpier road than we've been used to the last couple of years.
So subterranean tremors are starting to show their effects at the surface here. Was there anything really today that caused the Dow to go down 260 points?
Honestly, I don't think there was. You know, I've seen all of the headlines and Apple and the Russians. I think the truth of the matter is it's been a very good run. It was a lower volume day because of the Jewish holiday. And the reality is, again, we're getting to a point where if monetary conditions are changing, this becomes a little bit more normal. You know, we used to get 200-point days in the Dow. It wasn't that unusual. What's been unusual is we've gone so long without them.
Mm-hmm. You know, and we've gotten just used to one new high after another new high and just these small moves going up. And that's why I think a lot of people are wondering if we're in a new phase. And so a lot of people today were talking about maybe the correction is coming. It's been a long time since we've had a correction. What would a correction look like?
Well, you know, it depends where you're sitting. In some places, we're already seeing that. So we were speaking about small caps a moment ago. Small caps are down 8%. They're close to correction territory. And I think that's going to be an important element of this, that the market won't all be doing the same thing at the same time. Parts of the market, like the momentum stocks, biotech, some of the small cap names that have really benefited from strong momentum and where valuations have become stretched, those are the parts I think you're going to see experience the most drawdown. So this is an opportunity for investors to differentiate and think about what represents relative value in this market. And I think there are some areas, U.S. large cap, stocks in Asia, there are parts of the market that, while not screaming bargains, still look reasonable compared to the broader equity market.
All right, Russ, thank you very much. Good, sensible conversation there. Russ Kostrich with BlackRock.